Gary Jenkins was named in Credit Magazine's Hall of Fame for his role in developing Europe's corporate bond market. Gary, this seems like a political maneuver. Is there any muscle in what Germany is trying to do?
Not really. If anything, it could actually be counterproductive. It's clearly pandering to the home audience. But the shocking thing is not really what they've done, it's how they've done it. And I think that's what's really spooked the market.
So not telling the ECB, it seems, and going at it alone after the markets were already closed.
Well, this is the danger that, from an outsider's point of view, it looks as if at the top of the European Union there's complete division about how to deal with this crisis. And at a time of stress, you need unity. Now, if you're a sovereign wealth fund, China, Middle East, you're going to be looking at Europe and you're going to be saying, they don't know what they're doing, they don't agree on how to do it, the credit quality of the sovereigns are deteriorating, and there's problems with the currency, so why should I invest?
But this is nothing new. Europe has always been divided. They've very, very few times actually reached an agreement within the 27 member countries.
True, but at a time when you've got the biggest financial crisis we've probably ever experienced, you expect them actually to talk to each other before they made decisions which are fundamental to the way the market operates.
Gary, when you say this is counterproductive, why? Because actually investors from abroad look at Europe and say, what are they doing?
Yeah, exactly. It's not so much what they've done, because the idea that you can change the rules of the way the market operates is fine, that's up to them. But the basic thing here is that Europe, like other governments, any individual European government needs to issue a lot of debt this year, and it's all about issuing cash bonds, and therefore they need to get people enthused and encouraged about buying them. And you're not going to do that if you're changing the rules and you look as if there's disunity at the top.
But Gary, how do you justify the fact that actually a year and a half ago we were in the biggest financial crisis for over 100 years? We were talking about regulation, and as soon as the recovery started taking place, actually nothing's been done about it.
Well, I would say that we haven't got a proper recovery yet, because all we've really done is move the problem away from the banks to the governments. We need to get much further down the line where we have a stable market, where we have a real growing economy, and where the governments are stable before we can make major changes to the system.
A lot of the European leaders have been saying that actually this crisis has been exacerbated by the financial markets, by the way these credit default swaps work. Do we have any evidence of that?
I don't think there's any evidence of that at all. I think it's complete red herring. I think the problem lies completely at the heart of the fact that most European governments are over-levered, too much debt, have budget deficit problems, and they need to issue cash bonds. And it's cash bonds which are at the heart of the problem here, because there's just not enough investors who want to buy them. And that's the problem. Credit default swaps are really irrelevant in this situation.
But how can you justify a naked default swap when you're basically betting on your neighbour's house on fire without actually owning anything?
Well, I don't think that's a great analogy, to be honest, but again, I come back to the point, it doesn't really matter. If you banned all credit default swaps, if there was no such product from today, no one did it, it would not change the fact the European governments need to issue a lot of cash bonds, and there are not enough buyers for those cash bonds for them to be priced at the level the European governments need them to be.
The US will presumably face a similar situation down the line.
No doubt. I think, you know, you look at the moment, the focus is totally on Europe, and that means that places like the US are the reserve currency, they're a safe haven. Even the UK, which financially is in as much a mess as most of Europe, is seen as a safe haven right now because it's not the euro.
But even if you look at, for example, GDP to debt ratio, the US is more indebted than most European countries.
Absolutely, but it's still seen as an economy which can grow quite quickly and therefore can grow itself out of some of its problems. But there is no doubt that when people focus on the debt problems, they could easily end up looking at the UK and the US in the same light as they look at Europe.
What will it take for investors to be pleased about the way that Europe is reacting? Is it now too little too late? Really, whatever they do is not going to be interpreted as enough by the markets?
I think they have to be realistic when they're talking to the market, because they keep looking for these kind of bogeymans in the shadow kind of thing of blaming everyone, wolf packs and evil speculators, when in fact it's got nothing to do with that. The people they have to actually talk to are the normal long-term investors who buy government bonds.
But they put this $1 trillion package on the table, which was shock and awe. The market seemed to have liked that for a little bit, and then they got back to, well, like you're saying, these cash bonds they have to issue and these massive deficits.
Well, that's the problem. They did the shock and awe, and the actual figure, the 750 billion euros, was a big figure. But much more important was the announcement the ECB was buying government debt. That was the really important part of that, that announcement. Now, we just get to a stage where the market starts to calm down, and then Germany hits us with this, reintroducing volatility. It was a mad decision.
Gary, thank you so much. Gary Jenkins there.